I'm Sarah Borgson-Keeter with NAREITsREIT.com, and welcome to Quick Study, a monthly review of REIT market developments. I'm joined today by Brad Case, NAREIT's Senior Vice President for Research and Industry Information. So Brad, let's start off by talking about January. We saw a slight uptick, and that followed a fairly good month in December. What were we seeing in the month?
REIT investors overall in January saw a moderate positive month. The FTSE NAREIT All REIT Index was up just 0.25%. That was outpaced by the broad U.S. stock market. The S&P 500, for example, was up 1.9%. But that was driven really by the growth stocks in the economy. And if you look, for example, at the Russell 2000 Value Index, it was down more than 0.7% during the month of January. And it's funny because people used to think that REITs were really a lot like small cap value stocks, and that simplified view is really ended up on the dustbin of history by now. But over the last several months, we've really seen very dramatic differences between REITs and the part of the stock market that that has always been most similar to them and really was considered very similar to them. That was never a very that hasn't been a very accurate view over the last quarter century, and certainly that's what we've seen over the last several months. The other thing that investors were looking for last month, aside from growth stocks within the U.S., was non-U.S. stocks. So this was really a month for non-U.S. stock investors and for growth stock investors, and although REITs didn't do badly during January, it wasn't the hot part of the market.
And among the various sectors, were there any ones that particularly caught your eye? Sure.
As I mentioned, although the broad REIT market was up only 0.25 percentage point, there were really some fairly large movements among the different property type segments of the REIT market. For example, the strongest performing segment of the REIT market during January is timber REITs, with a total return of 3.7% just during that month of January. Other strong performers were manufactured housing REITs, performed very strongly. Mortgage REITs were up 1.7% on the month. Office REITs were up 1.6% of the month. When you look at the other end of the scale, several sectors did fairly poorly during January. Industrial REITs were down, for example, very sharply. And in that case, it's interesting. Industrial REITs, even after the month of January, even after they were the weakest performer in the REIT market during the month of January, they've still outperformed the broad stock market over the last year, as well as over the last 3 years, over the last 5 years. But you can't say that January was a correction, because when you look at the other segments of the market that have outperformed a very strong stock market over the past year, and they include office REITs, for example, which were up strongly during January. So a couple of the segments did perform very, very sharply differently from the broad U.S. REIT industry. But for investors that had a diversified exposure to the real estate market cycle through the U.S. REIT market, the movement in January was, a good one, a positive one, but only a moderately positive one.
And taking a broader view, what are some of the factors that investors are weighing at this time?
Yeah, well, I think investors are paying a lot of attention to what the transition of leadership in Washington is going to mean for the macroeconomic growth situation so far. And generally, what we've seen is investors seem to be optimistic that will increase earnings throughout the economy, and that will support higher stock prices for REITs as well as for non-REIT companies. And when you look at the interest rate situation, we saw a very sharp increase in interest rates during the last part of 2016. And really during January of 2017, interest rates were flat. That actually, has been a very bullish situation for REITs, because if you look at REIT dividend yields, the average dividend yield on equity REITs at the end of January 2017 was 3.95%, really unchanged from the end of December 2016. The average dividend on mortgage REITs was still above 10%, and those have been, and the spread of dividend yields relative to Treasuries has in the past been a very, very strong signal for future returns. So if you look at the current spreads, they're in a very, very bullish part of their range, and if historical patterns continue to hold into the future, then the current dividend yield spread suggests total returns over the next several years for REIT investors of well into the double-digit range. It's important to keep in mind that we can't tell to what extent the future is going to match the past, but we've got quite a bit of historical data suggesting that the dividend yield spreads that we're seeing right now are very bullish signals for the future.
Great. Well, thanks very much, Brad.
It's a pleasure.
And for more news and information on all things REIT, be sure to visit REIT.com.